Have you heard about index funds but wondered what they are? Everywhere you go, every other video on YouTube talks about index fund this, index fund that. But you want to know exactly how to get involved, how to get invested, and how to take advantage of the gains over a period of time. Well, this is the video for you because in this video, I'm going to break down exactly what index funds are. I'm going to tell you why they're so popular. I'm going to tell you why even the legendary investor Warren Buffett likes them very much, and how to actually invest in index funds. And as a bonus, I'm going to throw in some of the mistakes and some of the errors that I've made in my time as well. So let's get straight into it then. What is an index fund or an index tracking fund? So first of all, you need to understand what a fund is. So imagine you've got a big pot of money. So all the different investors all put money into this pot, and then that pot is then given to an investing manager, so a fund manager, and this fund manager then decides to decide what to do with that money. So it might go out and buy some bonds, or it might buy some stocks or some real estate. Whatever it does, that money comes from that pot of money that we've all put together. So that's called a fund. So an index fund is a fund that the money is used to track a particular index. So the question then is, what's an index? So an index is simply a particular market, and you're tracking the performance of the companies or the stocks or the assets within that market. So for example, you might have the US market, which is the biggest market in the world, the S&P 500. You have the 500 largest companies in America. So the S&P 500 tracks the performance of those companies within that index. Also, you'll have the likes of the FTSE 100, which is the 100 biggest companies in the UK. So the FTSE 100 will have 100 companies, and that index will track the performance of those 100 companies. You'll also have the FTSE 250. You can also have the European stock. You can have the German stock. You can have all sorts. So the index is basically the performance of those stocks within the index. And with the index fund, you're tracking the performance of those stocks within those index. Right. So how do you find these then? So in many cases, most index funds will track the performance of a geographical area, but you might also have something that tracks a specific sector. Say, for example, you want to track the performance of silver or AI or I don't know, something like healthcare or technology. So the index fund is designed to just track the movement of those. Now, in order to find them, I use my trusted tool, the Just ETF website. Now, the index funds can come in two different ways. You'll have something called a mutual fund or an ETF. Now, a mutual fund is a type of fund that tracks the index. However, the real differences are, with the ETF, you can actually trade all through the day. So you can buy the ETF as long as the market is open. So if the price goes up and you think, you know what, I can take advantage, sell some, make a quick profit, you can sell at the top. If it goes down, you think, you know what, I can sell and take advantage of the dip, you can do so with an ETF. With the mutual fund, they only allow you to trade once a day, usually either 10 o'clock in the morning or 4 o'clock in the afternoon. So whatever happens in between is completely irrelevant. The mutual funds will only execute those orders either to buy or sell within those the two times or the time that they trade. So anything that happens in between is irrelevant. Also, with the mutual fund, they tend to set a minimum amount. So they might say, in order to invest into this mutual fund, you need £25 or you need £100 or wherever the minimum is. Whereas with ETFs, generally speaking, it's as low as £1. And with the emergence of new platforms like Trading 212 that allow you to buy fractional shares, they'll just give you £1 worth of shares. Whereas with mutual funds, they will not let that happen. You'll need to have maybe £25 or £100, wherever the minimum is. Some of them can be as high as £1,000. So for that reason, most people will find ETFs more flexible, easier, and quite a lot more accessible than mutual funds. So for the sake of this video, we're going to use the ETFs. So I'm going to go to my screen. I'm going to use my trusted tool, Just ETF. This is where I used to then decide on where to go. So in order to invest, you need to first decide on what platform you're going to use. So I use Trading 212 simply because it's the cheapest one that I can find, the easiest one, and I just like how the platform is designed. There are others out there. You got AJ Bell, you got Interactive Investor, you got eToro, plus 500. There's absolutely tons out there. So you do some research, find out the cons and the pros. Look out for things like commission. Trading 212 is commission free, so I like that. Check out how much they charge for the FX transactions, so foreign exchange. So if you're going to buy, say for example, an S&P 500 fund that's in US dollars, and you're in a country like the United Kingdom, or you're in, I don't know, Brazil, wherever it is you are in the world, there will be a conversion from your local currency into the dollar. So some platforms will charge you for that transaction. So you want to keep that charge as low as possible. Also, you want to think about things like ongoing platform fees. So Hargreaves Lansdowne, for example, which was the first platform I used when I first started investing, they charge an ongoing fee in some cases. Certain platforms will not charge you at all. So just do your research, make sure you pick the right one for you, make sure that you're happy with the commission, you're happy with the fee structure, and so on and so forth. But once you've done so, you need to then decide on which particular index you want to track. Do you want to track the S&P 500? Do you want to track the UK FTSE 100? Do you want to track the world? You want to track emerging market? You want to track the healthcare sector? You want to track the IT sector? Whatever it is you want to track, you need to decide that bit. So for this example, I'm going to use the S&P 500. It's just a really popular one. So once you've opened up the Just ETF website, you can just type in S and P and then space 500, like so, and then you just click on search. It then gives you all the different options. So you got 88 different options there. If you click on that, it breaks them all down for you. So which one do we go for? I would typically first sort this out by total expense ratio. So the total expense ratio is how much the fund manager is charging you per year in order to manage this particular fund for you. So for example, this is 0.07%. So that means that for every £10,000 you invest, the fund manager will charge you £7 per year. And you got some as high as say 0.15, and you got 0.20, 0.09. So I would first put these in order of cost. So 0.03 is the cheapest one there. That's from SPDR. So that's the fund manager. And you see where it says UCITS, UCITS. That means that it's approved for European market. If it doesn't say UCITS, then you can't buy them in Europe. So you hear the American market say, people in America who invest in the S&P 500 will say things like VOO, VOO, or SPY. You can't buy those in Europe. You can't buy those in the UK because it's not UCITS. So it's not approved for the European market. So sometimes when they say the S&P 500 has hit the all-time highs in America, it might not necessarily be the case here because you're looking at two different funds. Theirs is the American version, ours is the European version. Still tracking the same the same index, but because there's a difference in one, the dollar, which is the SPY or the VOO, versus ours in pound sterling in the UK, there might be a slight difference there. Also, it means that you can't buy the VOO in the UK or in Europe. So once you've put them all in order of total expense ratio, remember that just because it's the cheapest doesn't mean it's the best for you. So you need to actually have a look at the different options there. So as you can see, that says unhedged. That means that it's not pegged to anything, which means that those foreign exchange differences will occur. So if you're buying in pounds and you're buying an asset in dollars, in this case the S&P 500, there will be a difference in the price of dollar versus the price of the pound sterling. So that there would then potentially have a cost from the platform, like I said earlier. Also, you see something that says ACC. or you see one that says DIST. So the ACC stands for accumulating. That means that any dividends earned, in this case, they normally pay the dividends every quarter, which is every 3 months. The dividends earned in the accumulating fund will automatically be reinvested into that fund. You won't have the option of taking it out. They'll just automatically buy more shares with that money and let the money keep compounding. Now, the distributing one is the option where they actually pay you out the money into your investing account, and you then have the discretion of what you do with that. If you want to buy more shares with it, if you want to take the money out, you want to use it to invest in something else, you want to pay your bills with it, it gives you that option there. So personally, I prefer the distributing for that reason, because sometimes I might want to invest in a new stock or a new fund or something else, or I might think, you know what, I want to retire now, I want to use this to pay my bills. I like to have that option, so I will do that. The other thing I'll also look at are things like the fund size. So you see this one here, for example, the X Trackers S&P 500 swap. So that's only got £1 million, whereas you got things like this, which is 12,324 million. So I probably wouldn't go for one so small, because when it comes to buying and selling, you might not have enough liquidity. There won't be enough people to sell to and people to buy from. So I probably would avoid that. Also, you can see that's not really traded even for a year, so that's performance in a year. So I might want to avoid that, but that's completely up to you, because the fees are quite low in comparison. Now, if you look at some of these, it gives you the replication style. So you see full replication. So in the S&P 500, for example, it means that the fund manager will go out and buy all 500 or the shares of all the 500 companies in that index. If it's a FTSE 100, they'll go out and buy the 100 shares in that index. So it's called full replication. With the swap, they're using advanced finance to replicate the index. So rather than going out to buy it, they're using advanced finance to do so. You also want to look at different performances. So some of them have performed a bit better than others. As a general rule, the accumulating will perform better than the distributing, simply because the compounding is allowed to happen a lot quicker. But it means that you don't have the option of whether or not you want to use that money. By far, the most popular one in the UK is probably the Vanguard ones or the iShare ones. So you can see the iShare ones there, which is the fund size is 93.455 million, versus some of these other ones that are substantially smaller. So that's the S&P, that's the Vanguard version. So you've got the accumulating one there, and you got the distributing one. So for the sake of this, I'm just going to pick the Vanguard distributing one. Once you click on it, that opens right up there. And the beauty of just ETF is it gives you a bit more information now. So it tells you the current price, so that's 90.79. If you scroll down a bit more, you got the chart there. So it tells you 1 month, 3 months, 6 months, 1 year. So before you buy an index, you might want to check that the price is going up gradually over time, because you're backing an index that's growing your money. If it's the reverse of this and it's going down gradually, then you might want to rethink what you're putting your money into, because the whole point of investing is for you to grow your money over time. Now if you look at this chart again, they tell you that the S&P 500 on average gives you 10% return per year. It doesn't mean you're going to get 10% every year necessarily. Some years it might be 24, some years it might be -1, sometimes it might be 10, sometimes it might be whatever. So, and if you look at the chart, you can see how it goes up and down, and then up again, and then down again. But overall, it's on an upward trajectory. Okay, so that's what you want to look for. So it doesn't matter the time frame you look at. You want to make sure that you're backing something that's going up over time. So if you scroll down a little bit more, this tool gives you a bit more information. So you got the index, which is the S&P 500. You got the investment focus. So equity, that's just a fancy name for stocks. United States, it gives you the fund size, the total expense ratio, so how much you're paying the fund manager, 0.07% per annum, which means £7 for every £10,000 you've invested. Replication style, legal, so ETF rather than a mutual fund. So longs only means you're betting that the price will go up. If you said shorts only, it means you're betting that it's going to go down. Usually the US dollars, that's the currency. This means that it's unhedged. That means that the currency exchange will play a part in there. So when the dollar is up versus the pound, the price will be different versus when the pound is up versus the dollar, and so on and so forth. You can see when it started, this says it's distributing, which means the payout, rather than automatically reinvesting the dividends for you. The frequency of the dividends is quarterly, so once every 3 months. This fund is based in Ireland, and the fund provider is Vanguard. So this breaks it down nicely for you. So let's say you're happy with that, you're thinking, okay, this is the one I'm going to go for. This is how you actually invest in that S&P 500 ETF or the tracking fund. So you look at the ticker symbol, that's the actual unique symbol for this fund. So you just go back into your trading platform. Remember, I'm using Trading 212, but you can use whichever one you like, and you simply type in there VUSA, and you can see there's 3 versions of that. You got one based in London Stock Exchange, one based in Amsterdam, and another one based in Swiss francs in Switzerland. I will go for the London one because that's where we're based in the UK. If you're based in somewhere in Europe and your local currency is euros, then you might want to use the euro one. It means that you're not having another foreign exchange exposure. If I was to go for the euros, then that means I will have to convert from pounds to euros, then to dollar, and then vice versa when it comes to selling. So it's easy to just stick to my local currency in pounds. If you're based in Switzerland, then you might want to use the Swiss francs. So you just simply click on that one now. Now, bear in mind, I'm on a laptop. On your phone, the layout might be different, but no matter what, you'll have an option to buy. Depending on the platform, it might be somewhere else on the screen, but once you've located the buy, you just simply click on buy. Then you'll have 4 options. You got market, limit, stop, or stop limit. For the sake of this video, I'm only going to explain market and limit. So the market option means that you're going into the market and they're going to try buy the shares as close as possible to the current price on the screen. So the current price on the screen is £90.7575 pence. So say for example, I've only got £1 to invest. You just type in £1 in there, and because of fractional shares, the system will simply give you £1 worth of shares in this particular fund. In this case, you get 0.011 shares of the S&P 500 ETF. Okay, so once you click on review, you get a summary. So that tells you market buy, it gives you the number of shares you get there, 0.011, the value, which is £1. Because it's Trading 212, it's commission free, and that's the total. Now, with it being a market buy, the system will try its best to find you the best price or the closest price to that amount. That doesn't mean you're going to get what's shown on screen. You may well get it at £91, £92, whatever it is, but the system will try its best to find a share on sale for as close as possible to the price shown on screen. So you simply click on buy. Now, because it's the weekend we're filming, the market is currently closed. So this will not execute until the market reopens on Monday, which is in a day and 9 hours time. So the system will sit there Monday morning when the market reopens. It will then go into the market and say, right, I'm looking to buy £1 worth at close to or at this current price, 90.75. Now, don't be surprised if that executes at £91 or 92 because it's a market buy. So you click on OK, and then that instruction is being sent and it's waiting to be executed. Now, if you're not happy with that, you're thinking, you know what, I don't really want to risk it going up to 92, 93, whatever it is, you might want to use a limit buy. So what the limit buy does is to say, right, I want to pay a maximum of this amount. So once you put your order in, the system will go away and say, right, anything above this, I'm not interested. Anything on this amount or lower, then I'll execute. So in this case, I use this slider, and with this slider, you can see 0.011 shares at £1. You then type in the maximum amount that you want to pay. So for the sake of this video, I'm just going to put £91. Okay, so that means that if the market opens on Monday higher than £91, it won't execute. It will just wait till that price is hit. If the price never hits 91, so say for example on opening on Monday it goes to £97 and it never gets back to £91, it means that I simply don't buy that stock. Now that's a negative in itself, because you might have missed out on that growth for the day, who knows. But it might also be a positive, because you might not even want to spend £97. You might think that's overpriced for this particular fund, so in which case you're thinking, yeah, oh well, that's fine. So you review the order. Now you see in this case they're saying that it has to be greater than that value, so I'm going to simply change that from 0.011 to 0.012, and that now tells me the new price, which is £1.09. So I've set my maximum price and I just review the order. It now gives me a summary again, so it tells me it's a limit buy. It means that I've set the maximum amount I want to pay. I've told it how many, it's telling me how many shares I get for the amount I'm paying. So £1.09 gets me 0.012 shares. That's the limit price that I set. This says expiration date, which is never, which means that you just keep trying until that price is hit, and if it's not hit, then you just keep trying. When the market is open, it'll give you the option for end of the day, which means that it'll only try for the duration of the market being open. Once the market shuts and that order's not been executed, it'll just be cancelled, and the money will be deposited back into your account. So it won't keep trying like it's never. It will just assume, right, end of the day now, that's it, done. Commission is still free, and then it gives you the total price there. So you simply send that buy order, and then that's it. Again, because it's the weekend, that will not execute till Monday. Now once the market opens on Monday and that executes, it means that you're now a proud investor in the S&P 500. So just to think about it, you're now a person who owns stocks in 500 of the biggest companies in America, because you bought this ETF, or you bought this mutual fund, or you bought this index fund that tracks the performance of them. In this particular one, which is using a full replication, you actually own some of those shares, which is a powerful thing. And just to give you an idea, 93% of actively managed funds, these are people who've gone to school to learn this stuff. So these are the people who've gone to Oxford, Cambridge, Yale, all these prestigious institutions to learn how to do these things, cannot beat passively managed index fund like this one. So the computer simply picks the stocks within that index and just tracks it. It's not trying to beat it, it's not trying to be clever, it's just matching it. And 93% of actively managed funds cannot even beat that. So it means that simply by investing in an index fund like the S&P 500, you're better than 93% of those people who go to school to learn it. So in most cases, for most beginners, this is perfect for you to invest in. You don't need to worry about anything else, because a lot of times people trying to pick it cannot beat this particular way. So now that you know what index funds are, why people love them so much, the low fees, how easy it is to analyze them using the Just ETF tool, where to actually find them, also using your platform to purchase them, you're now good to go. You're now ready for your investing journey. If you learned anything from this video, if you actually have had any value from it, make sure you like, make sure you subscribe, make sure you share. The sharing is very important, because there are people out there dying for this information. There are people out there who want to know this, but they don't know where to start. Get that to them. Let them make the most of it. Let them start their investing journey. And there are people who are already doing something else, and they might think, you know what, I want to also add index funds to my portfolio. So this might be one for those kind of people. But make sure you like, make sure you subscribe, and don't forget that notification button. It's Roadman Investor. Join me next time.